Brightcove, the enterprise video king that YouTube dethroned. In 2004, when watching a video online meant waiting 10 minutes for a pixelated clip to buffer, Jeremy Allaire had a vision that would briefly make him the king of enterprise video streaming. Allaire, who had previously founded web development platform Allaire and sold it to Macromedia for $360 million, wasn't content with the primitive state of online video. While most people were still sharing grainy QuickTime files via email, Allaire saw an opportunity to build professional-grade video infrastructure for businesses and media companies. He founded Brightcove with the audacious goal of becoming the backbone of the internet's video revolution, targeting enterprises willing to pay premium prices for reliable, customizable video hosting and delivery. The company launched with $8 million in Series A funding, positioning itself as the sophisticated alternative to amateur video sharing sites that were beginning to emerge. Brightcove's early pitch was compelling. While consumer platforms offered basic video hosting, they provided enterprise-grade analytics, customization, security features, and white-label solutions that major corporations and media companies demanded. The timing seemed perfect, as broadband adoption was accelerating and businesses were finally recognizing video's potential for marketing, training, and customer engagement. Brightcove's enterprise-focused approach initially paid massive dividends, attracting an impressive roster of high-profile clients who needed professional video solutions. The New York Times became an early adopter, using Brightcove to power their video content strategy as traditional print media desperately sought digital revenue streams. Discovery Communications, MGM Studios, and Ford Motor Company all signed substantial contracts, drawn to Brightcove's ability to handle high-volume video delivery with advanced features like geo-blocking, detailed viewer analytics, and seamless content management systems. The platform could deliver adaptive bitrate streaming, automatically adjusting video quality based on viewer connection speeds, a sophisticated feature that consumer platforms lacked. Major sports organizations, including the PGA Tour and various NASCAR properties, used Brightcove to monetize their video content through subscription models and pay-per-view events. The company's technology powered live streaming for significant events, including presidential debates and corporate earnings calls, establishing Brightcove as the go-to solution for mission-critical video broadcasting. Their client roster expanded to include Reuters, which relied on Brightcove for distributing breaking news video to media outlets worldwide. By 2005, Brightcove was processing millions of video views monthly for enterprise clients, generating substantial recurring revenue through software-as-a-service subscriptions that often cost thousands of dollars per month. The competitive landscape shifted dramatically in February 2005, when 3 former PayPal employees launched YouTube from a garage in Menlo Park, fundamentally altering the economics of online video. While Brightcove charged enterprise clients monthly fees ranging from $500 to $50,000 depending on usage and features, YouTube offered completely free video hosting to anyone with an internet connection. Initially, Brightcove executives weren't concerned, viewing YouTube as a consumer novelty that couldn't threaten their enterprise market dominance. YouTube's early limitations seemed to validate this dismissal. Videos were capped at 10 minutes, quality was mediocre, and the platform lacked the sophisticated content management and analytics tools that Brightcove's corporate clients required. However, YouTube's viral growth was unprecedented, reaching 8 million videos viewed daily by December 2005, just 10 months after launch. Google's acquisition of YouTube for $1.65 billion in October 2006 dramatically accelerated the platform's development and provided virtually unlimited resources for improvement. Suddenly, YouTube wasn't just a scrappy startup, but a Google-backed competitor with the engineering talent and financial resources to rapidly enhance their platform. The acquisition sent shockwaves through the video industry, as investors and companies began questioning whether premium video platforms like Brightcove could justify their high costs when Google was offering similar core functionality for free. Brightcove attempted to compete by going public in February 2012, raising $28 million in an IPO that valued the company at approximately $180 million, significantly less than the billion-dollar valuations that YouTube and other video platforms were achieving. The public offering was intended to provide capital for product development and market expansion, but it also exposed Brightcove's fundamental growth challenges to public scrutiny. revenue growth was slowing as potential clients increasingly questioned the value proposition of paying premium prices for video hosting when free alternatives were rapidly improving. The company's stock price struggled from day one, closing at $10.71 on its first trading day, below the $11 IPO price, signaling investor skepticism about Brightcove's long-term viability. Quarterly earnings reports consistently showed the strain of competing against free platforms, with customer acquisition costs rising while average contract values stagnated. Brightcove's management team attempted to justify their premium pricing by emphasizing advanced features like detailed analytics, content security, and customer support, but these advantages were becoming less compelling as YouTube and other platforms enhanced their offerings. The company's enterprise sales model, which had been a strength in the early days, became a liability as potential clients could implement YouTube-based solutions in minutes rather than enduring months-long enterprise sales cycles. The fundamental economics of video hosting worked against Brightcove as cloud computing costs plummeted and content delivery networks became commoditized services. Amazon Web Services launched their video hosting and streaming services, offering enterprise-grade features at prices that undercut Brightcove's model by orders of magnitude. Microsoft entered the market with Azure Media Services, leveraging their existing enterprise relationships to offer video solutions as part of broader cloud packages. Vimeo, initially positioned as a premium alternative to YouTube, began targeting Brightcove's small and medium business clients with professional features at significantly lower price points. Even Facebook entered the enterprise video space, offering businesses free video hosting with built-in social media integration that Brightcove couldn't match. The proliferation of video hosting options meant that Brightcove's clients had numerous alternatives, creating pricing pressure that the company struggled to address while maintaining profitability. Many long-term clients began migrating to hybrid solutions, using free platforms for general content while maintaining Brightcove subscriptions only for the most sensitive or specialized video requirements. This client behavior pattern significantly reduced average revenue per user, a metric that Brightcove's public investors watched closely. YouTube's evolution from amateur video sharing site to sophisticated platform capable of serving enterprise needs represented an existential threat that Brightcove never successfully countered. Google continuously invested billions of dollars in YouTube infrastructure, expanding global content delivery networks, improving video quality, and adding professional features that directly competed with Brightcove's core offerings. YouTube introduced live streaming capabilities, advanced analytics through YouTube Analytics, and monetization options that allowed businesses to generate revenue from their video content. The platform's massive audience became an additional value proposition. Businesses could reach billions of potential customers through YouTube's recommendation algorithms and search functionality, something Brightcove's closed platform couldn't offer. YouTube's integration with Google's advertising ecosystem provided businesses with sophisticated targeting and measurement tools that often exceeded what Brightcove offered. Major media companies began questioning why they should pay Brightcove's premium fees when YouTube could deliver both video hosting and potential advertising revenue. The network effects of YouTube's platform meant that content posted there had the potential for viral distribution, while Brightcove-hosted videos remained isolated within corporate websites with limited reach. Brightcove's attempts to differentiate through specialized features and superior customer service proved insufficient against the overwhelming economic advantages of free platforms. The company invested heavily in developing advanced analytics, content security features, and integration tools, but these enhancements required significant research and development spending that pressured profitability. Their customer success teams provided white-glove service that YouTube couldn't match, but many businesses decided that slightly inferior support was an acceptable trade-off for dramatic cost savings. Brightcove launched various product initiatives, including social video tools and marketing automation features, attempting to expand beyond basic video hosting into comprehensive digital marketing platforms. However, these efforts often put them in competition with specialized companies that could focus entirely on specific functionalities rather than trying to maintain a broad video platform. The company's engineering resources were stretched across multiple product lines, making it difficult to achieve the rapid innovation pace that venture-backed competitors maintained. Sales cycles remained lengthy and expensive, with enterprise clients demanding extensive customization and proof-of-concept implementations before signing contracts, while competitors offered self-service options that eliminated sales friction entirely. By 2015, Brightcove's market position had deteriorated significantly as the video hosting industry consolidated around a few dominant platforms and numerous specialized niche players. The company's stock price had declined from its IPO levels, reflecting investor concerns about long-term growth prospects in an increasingly competitive market. Major clients, including ESPN and other high-profile media companies, began reducing their Brightcove usage, either moving to free platforms or negotiating significantly reduced contract terms. The rise of mobile video consumption further challenged Brightcove's model, as businesses needed solutions optimized for social media platforms where their audiences were increasingly consuming content. Instagram, Snapchat, and TikTok emerged as critical video distribution channels, none of which integrated well with Brightcove's enterprise-focused platform. The company attempted to address these trends by developing social media integration tools and mobile-optimized players, but they were constantly playing catch-up to platforms designed from the ground up for modern consumption patterns. Marketing budgets that previously would have been allocated to premium video hosting began shifting toward social media advertising and influencer partnerships, reducing demand for Brightcove's traditional services. The final blow to Brightcove's dominance came as artificial intelligence and machine learning capabilities became standard features in video platforms, advantages that Google's YouTube could implement at scale while Brightcove struggled to match with limited resources. YouTube introduced automatic captioning, content moderation, and recommendation systems powered by Google's AI capabilities, features that would have required massive investments for Brightcove to develop independently. The platform's global reach and local content delivery infrastructure surpassed what any independent video company could economically maintain. In 2019, Brightcove's revenue had stagnated at approximately $180 million annually, a respectable number for a software company but far below the growth trajectory that video industry observers had predicted during the platform's early success. The company survived by focusing on specific verticals like healthcare and education, where regulatory requirements and security concerns still justified premium pricing, but their dreams of dominating the video infrastructure market had definitively ended. Several acquisition rumors circulated as potential buyers recognized Brightcove's technology value and client relationships, but the company remained independent, serving a much smaller market than the expansive video ecosystem they had originally intended to capture. Jeremy Allaire had moved on to found cryptocurrency company Circle, acknowledging that the video hosting market had evolved beyond Brightcove's original business model. Brightcove's story illustrates the ruthless economics of platform competition, where even sophisticated technology and strong client relationships cannot overcome fundamental cost disadvantages and network effects. The company built excellent enterprise video technology and served major clients effectively, but they were ultimately competing against Google's virtually unlimited resources and willingness to subsidize YouTube's development through advertising revenue. Their premium pricing model, which seemed sustainable when video hosting required specialized expertise and expensive infrastructure, became untenable as cloud computing commoditized the underlying technology. The shift from desktop to mobile video consumption accelerated the decline, as businesses needed to reach audiences on social platforms rather than hosting content on corporate websites. Brightcove's experience demonstrates how quickly market leaders can be displaced when new competitors offer similar functionality at dramatically lower costs, especially in technology markets where switching costs are relatively low. The company's survival in specialized niches shows that even disrupted platforms can find sustainable business models by focusing on specific customer segments with unique requirements that mass-market platforms cannot economically address. However, their trajectory from industry pioneer to niche player represents one of the most dramatic examples of how free, advertising-supported platforms can devastate premium subscription-based competitors even when the premium option offers superior features and service quality.